All right. So we've reached the 11 o'clock mark, so I think we're going to get going. I'm sure more people will kind of keep filing in. So I just wanted to welcome everybody, and thanks for attending our webinar today. At 360 Energy, just a little bit about us. We design and implement energy strategies in order to reduce the organizations that we work with, their carbon footprints, and avoiding unnecessarily energy use and costs. So this webinar that we're doing today, or that we're hosting today rather, is part of a series of webinars that 360 Energy is presenting to keep corporate leaders objectively informed of the many changes, including risks and opportunities occurring in the energy industry. These days, companies are under increasing pressure from a broader group of stakeholders that are obviously demanding more sustainability-related information and action from the private sector. Bankers, investors, asset managers all require climate-related financial disclosures from companies to evaluate their risks and exposure over time. So today we have Bob Willard. He's the gentleman up there on the screen, if you can see him there. He's a leading expert on quantifying the business value of sustainability strategies, which is, of course, extremely important. He's going to be comparing and contrasting the most popular environmental, social governance, and sustainability reporting frameworks to enable you guys to make more informed decisions on which reporting framework might be most appropriate for your company in order to consider when reporting its energy, greenhouse gases, waste, water, community, and other sustainability impacts. So we're going to get going with him in just a moment. I just have a few housekeeping notes as well. Our next webinar, just to kind of give you a heads up, we have a webinar on April 23rd that's going to be by Alan Fogwell, who's the President and CEO of the Canadian Energy Research Institute. He'll be talking about Canada's industrial competitiveness and energy efficiency. So that's something to look out for. We'll be sending an invite out to that reasonably soon. Just in regards to the webinar today, of course, I've got everybody on mute just to kind of cut down on background noise. That's kind of the usual thing that we do. If you do have any questions, we encourage you to use the question function, ask questions throughout the presentation. I've asked Bob, he is absolutely okay with me jumping in and kind of interrupting with questions that he can follow up on. So if he says anything that you want to know more about or more details, jump in, feel free to ask the question, and I can definitely pose that question to Bob as we go along. So again, please use that question function on your little toggle for the webinar. And without any further ado, I'm going to hand it off to Bob to get started. Thanks for joining us today, Bob.
It's a pleasure. Thanks, Julie, and thanks for the introduction. What I'm going to do is go through a fair number of slides with you. Just to reassure you, you'll get all of these after the webinar as well. So if you want to go back to any of them and explore some of the footnotes or any of the content more, you'll have that opportunity to do that. So let me just put a little context around what we're going to be talking about here. ESG is a synonym for sustainability. Some of you may also have known these reporting frameworks under the mantle of CSR, corporate social responsibility. Basically, they're all talking about the same thing these days, but because ESG is a nice abbreviated word compared to sustainability, that's a handy one to use. It's also the one that's used quite a lot in the business community as a substitute for sustainability. So I'm going to start off with a big picture as to what this sustainability stuff is all about. And I'm sure you're aware of this, but basically it's made up of three different dimensions: the environmental, social, and economic or business dimension. So the big one, of course, if you look from space at us, mostly what you see is environment. You see air, you see land, you see water. And if you look closely, you see living things. And if you're looking for us, we're mostly on land. So human society, which is about 7.78 billion of us these days, it puts some strain on the carrying capacity of the environment, of the planet. Just to reinforce that, when I was born, there were 2.4 billion of us on the planet. So in one human lifetime, the population of the planet has more than tripled. And that has some significant implications for the ecosystem services that we rely on so that we can have a useful life and a flourishing life. Within society, we do things for each other. If it's family and friends, we do it for free. And if it's other folks, we do it for a fee, and that's called a business. So this is a way in which we can show the three dimensions in a nested relationship. And in fact, the punchline of this, just as a reminder, is that environment is the holding company for society and business, that society and business are wholly owned subsidiaries of the environment. And we want to make sure the holding company is in good shape. So we need to report on some of the ways in which we are impacting the environment, both negative as well as positive. So that gets into the reporting part. And in fact, it also leads to the fact that for the last 250 years, since the beginning of the Industrial Revolution, business has been impacting both of those nests, the environmental nest and the social nest, sometimes in a positive way, many times in a not so positive way. And because those are normally considered to be externalities for business, they haven't really been required to report on how that's going until more recently. The expectations both of society and of other important stakeholders is starting to go up, that they would like to see how the company is impacting those nests, as well as how the nests are impacting the business. Because as things get more scarce, as some of the regulatory functions of the environment and the ecosystems start to become more stressed, the business itself is being impacted by both social and environmental factors. And a lot of stakeholders are curious as to how that's going to impact the business and whether it raises some risks that weren't there before. So that leads to the fact that businesses need to have a business model that acknowledge the existence of the environment and society and the way in which the operation of the company impacts those nests. So the business model might look something like this. If we're to acknowledge the environment and society and business and show the flows of how things go from the environment, the environment is the ultimate source of the goods and services and the resources that the company takes in. When it uses those, it may have some impacts on the environment by its presence wherever it is, and it may also be impacted, depending where it is, by some of the severe weather events or whatever, so the environment could be impacting the business that way. And it produces goods and services, and those products go to people. When they use the products, they may impact society and the environment, and when they get rid of them at the end of their useful life, that may also happen as well. And hopefully in a circular economy, those things go back and become either inputs for the company itself or inputs for other companies that can use those as its raw material. So that's sort of a big picture view of a business that is taking things in, doing something useful with them, producing them for others to use, and so on. And as we get into the reporting on how it's going on all of that, there are basically two kinds of reports. For a listed corporation, they need to produce an annual report that shows how it's going from a financial perspective, the income statement, the balance sheet, and some commentary usually at the end, especially for companies in North America, which gives a bit of an outlook, acknowledges risks that may be there and what the company is doing on it. So that's the management discussion and analysis. So that's the usual thing that is put out by large companies and incorporated companies. And then we also have reports that are describing how it's going on three other things. And these are called sustainability reports, ESG reports, CSR reports. And normally they talk about the positive and negative impacts on the environment, the big nest, and also the positive and negative impacts that the company is having on the communities where it's operating, on society at large, and on its own employees. So those are the things that are normally talked about in a sustainability or ESG report. Just to put a little bit more context around these, Some people call the annual report the report on the financials, and the sustainability report on the non-financials. So that's another label for all of these kinds of impacts. An annual report is required for any company which is a public company owned by shareholders. And the other one is voluntary. It's something which companies don't have to do, or at least don't have to do until recently. And it's intended for all stakeholders, whereas the annual report is basically for the owners, the shareholders and the investors in the organization. That gets into audience. And the audience of these reports that are put out under the guise of sustainability or other labels need to be designed and written for an audience. Is it your customers? Is it your communities? Is it your employees? Who are you hoping is going to read this? The origin of a lot of those reports were based heavily on philanthropy and the company reporting on how it's doing useful things for causes in the community and showing its good corporate citizenship. And in fact, some of those reports were called citizenship reports. So the labels evolve, and depending on the sector, they may also be different, but basically those are the kinds of things that they talk about. So those are the big kind of categories. What I'm going to do now is show you the kinds of things that are usually covered when we're talking about environmental, communities, society, and employee impacts. So what are the issues that the company normally discusses, how it's doing on the topics? So the sustainability issues relate to that business model this way. It talks about how the company is impacting the environment with what it takes from the environment for energy, water, materials, goods, and so on. Are there impacts on the environment, both positive and negative? And the way in which the environment is being impacted by its operations and by the product's use and disposition at the end of their useful life in terms of greenhouse gas emissions, other kinds of emissions, waste, and encroachment or impacts on biodiversity. So those are the environmental kinds of things, and those are the usual 7 factors that are looked at. In terms of what's going on in society, the company reports on the way in which it is positively or negatively impacting the community, and because these are usually voluntary reports, of course, the emphasis is going to be on the positive side. Some of the reports also include information about the way they're helping governments do the right things for society by paying their taxes, the way in which they operate, what they lobby for, and the companies that they invest their money in to ensure that those companies are also doing useful things for society. And then we have the way in which they are treating their employees. This gets into human rights and the extent to which they are doing the right things in terms of paying them properly, looking after their health and so on, not hurting them, discrimination and so on, kinds of factors. And then we have another aspect, which is the G part of ESG, the governance. Are they set up to do the right things and bring all of these considerations to bear when decisions are being made either by the board or by the executives in the C-suite? So that's the collection of things that you would normally see addressed in a complete, comprehensive kind of sustainability or ESG report. So let me give you an overview of all of the different variations of the frameworks that are being used these days to report on these things. So these are the ones that have to do with how the company describes how it's performing today relative to how it did last year or some other baseline year on each of those issues, and how it's making progress towards goals that it has set for itself in terms of its performance on each of those issues. And the reporting frameworks that are most commonly used are the Global Reporting Initiative, GRI, the Sustainability Development Goals, SDGs, IR, which is integrated reporting. Then we have some recommendations by the Sustainability Accounting Standards Board on what they should be reporting on, the Task Force on Climate-Related Financial Disclosures, TCFD, B Corps that may want to be assessed by the Business Impact Assessment Questionnaire and be certified as benefit corporations, and ISO 26000. So that's a collection, which I'll be coming back to, that talks about how the company is performing relative to how it was performing and in the future on the issues that we just looked at. You should also be aware that there are some other frameworks that are used to compare how this company is doing relative to others in its sector or just others. So there are ratings and rankings of companies' performance on these kinds of sustainability issues. And there are also frameworks that allow it to be compared to where it needs to be a truly sustainable organization based on best available science. And that's the FutureFit Business Benchmark. And then these other ratings that I mentioned compare the company to how it's doing against other companies. And there are lists put out that show the top 100 most sustainable companies on the planet, usually corporations, big companies, by Corporate Knights, spelled with a K, in Toronto. The Dow Jones Sustainability Index, the CR magazine puts out the 100 best corporate citizens, and the CDP group looks at how the company is doing on carbon, water, and forests. So that's the big picture. What I'm going to do now is drill down into some of these and give you a sense of what they do and they don't do, what they cover and what they don't cover, so that you get a sense of how they might be useful as frameworks that you might want to tap into. Any questions so far?
Not so far yet. Just a reminder, if anybody does have any questions as they go along, feel free to use the little question toggle, and I'll definitely read them out. Nothing yet, though.
Okay, so what are the most popular ones that are used out of this maze of different options? And it turns out that there are people that do take a look at that. And one of those groups is the World Business Council for Sustainable Development. And they put out a report that showed that a lot of companies are using the GRI. That's the granddaddy of all of them. It's almost the de facto framework for reporting on sustainability. Most reports reference the Global Reporting Initiative. They either say that they're using it or that they are using a variation of it that shows that they're honoring the spirit of what those guidelines ask companies to report on. And then we have the Sustainable Development Goals, which are acknowledged in a lot of these reports, at least in some way. And it also shows which of them are prioritized or most material to companies. So that's another framework that we'll talk about. And then there's this thing called integrated reports, which take both the financial, the orange ones that I was showing before, and the non-financial information, the green one, green box, and put them into a single report so that they're not two reports, they're integrated reports. So if those are the three most popular ones, why don't we start off and take a look at those, and then we'll come back and look at a couple of the others. So the Global Reporting Initiative, this one is used very, very heavily and for good reason. It has wonderful guidance on how to report and calculate how you're doing on all of the things that we've talked about. So there are many documents that you can tap into for all of that guidance. Some are overall guidance, and some of them drill down at the economic, environmental, and social aspect of a company's operations and how to appropriately report and calculate how you're doing on the various indicators associated with those. So in terms of the superset of all of the issues that we looked at before, they talk about all of them, except for maybe two. They don't explicitly ask companies to describe the extent to which they paid their taxes, both property taxes and income taxes, and they don't necessarily talk about the way in which the company is investing its money. But they do cover all of the other bases. So the GRI is an excellent framework, and that's why it's used. It's comprehensive and very, very complete. So let's take a look at the SDGs. Oh, sorry, let me just go back. FutureFit Business Benchmark. The FutureFit Business Benchmark, just to position that relative to the GRI. The GRI allows a company to say how it's doing today, relative to how it did or how it's going to do. The FutureFit Business Benchmark gives a company an opportunity to report on how it's doing relative to where it needs to be if it is to be a truly sustainable organization. and at least not doing any harm to the two nests that we looked at before, the environmental and the social nest. So the FutureFit business benchmark has a bunch of cause no harm goals, and they cover all of the environmental things that we talked about before. But what they say is, ask is, how much of your energy is from renewable sources? What % of your energy? And how are you doing on greenhouse gases? Are you reducing them from a baseline year? And how close are you to getting to zero on greenhouse gases? And so on. So it's on a % scale, 0 to 100%, as to how close you are to where you need to be on each of the things that we looked at before, both on the environmental ones, associated with the operations of the organization, associated with the products that the company produces, associated with the way in which it's treating its employees, the way in which it is connecting and impacting the communities where it is operating and society at large. So it has goals associated with all of those, 24 of them, 24 goals that are a pretty complete superset of all the things the company needs to do. It's looked after by the FutureFit Foundation in the UK. I helped write the first version of it, and in fact, these that you're looking at, it's really, really good if you're trying to see how close you are to where you need to be. And it's sort of the GRI on steroids in terms of the rigor that it brings to the calculations. And it also gives you a chance to report on not only how you're not causing any harm, which is this label at the bottom, but also whether or not you're actually having some positive impacts. And those they call positive pursuits. And there are 23 different ways in which you can have a positive pursuit. So not only are you reducing your dependence on fossil fuels and using more and more renewable energy, you may also help others depend less on non-renewable energy, and helping others have access to energy that they didn't have access to before. So if you've got solar panels or wind or on your site, and you're generating more electricity than you need, you can sell it back to the grid so others can take advantage of it. And it also not only talks about not harming ecosystems, but are you helping to restore them? Are you helping remove greenhouse gases from the atmosphere? So these are positive kinds of things that you can do to be able to help us get to where we need to be and recover from some of the damage that's been done previously, either by yourself, your own organization, or by other organizations. So there's a collection of positive pursuits and a collection of cause no harm things or break even goals, and companies can assess themselves on how they're doing on all of those.
Bob, just
Yes.
to interrupt, we've got a question and then another comment. I apologize, we were having some technical difficulties. I think the GR overview was frozen for a part of that slide, so we might need to just kind of take a look at that again. But we also have another question, is who's checking the accuracy of these reports? Are the GRI, FFBB all self-reported? And are any of these reports audited by an independent third party?
They don't have to be, but they should be. So that's one of the first things that people that look at these reports take a look at. Have these been audited by third parties? Are they by accountants to ensure the accuracy of the numbers, accountants who are trained in this, or by non-governmental organizations that are really, really expert at this stuff? So assurance or audits by third parties have a lot to do with the credibility of these reports. Companies are known to kind of hype up some of the good stuff that they're doing, especially, and ignore the bad things that they're doing that they don't want to report on. So it is helpful to have more neutral eyes brought to bear on what is reported. And in terms of what I was talking about with GRI, I'll just go back to the fact that it's a very, very complete, robust set of guidance on how to report on all of these things that you see, except for the taxes and investments. And it's really, really good, really good. Except it doesn't really talk about how the company is doing or help the company calculate how it's doing relative to where it needs to be on all of those same issues, which is what the FutureFit Business Benchmark does. Okay.
Thanks for that, Bob.
All right. So let's talk about these things called the Sustainable Development Goals, relatively new arrivals on the scene, came out in 2015. The Sustainable Development Goals are 17 goals that the UN put together for societies anywhere on the planet. So what we're talking about are 17 things that we would like to pay attention to and be able to reach by 2030. So there is a deadline associated with these goals. So they would really like to be able to get to, as you can see from number 1 and number 2, no poverty and zero hunger by 2030. And it goes all the way through to some of them at the end, which are a little bit more inclusive in general. So it's a good 17. In fact, it's a pretty good blueprint for the kind of society that we would all like to be able to have for both ourselves and our future generations. And we can take those and we can resort them into more familiar kinds of groupings. So ESG related groupings of the same SDGs would have 6 of them that are fundamentally concerned about the environment that we are going to be living in. So they have to do with water, they have to do with energy, consumption and the materials used in a circular economy, climate change, the marine ecosystems and the health of the marine ecosystems, and the terrestrial ecosystems and the health of those as well. So environmentally related goals, 6 of them. There are 6 that the company can most effectively contribute to through the way in which it treats its employees. And those are those 6 there, that how much it pays them and so on, and the way in which it treats them and looks after them. And then there are 5 which have to do with how it can contribute to these through its lobbying and taxes and those kinds of things. They're important. They're important not only to society, but they're also important to business because it needs the infrastructure that's talked about here, and it needs sustainable cities and communities that are going to be able to take advantage of their products and services and so on. So it's a pretty good set of things. And I've nested them here into 3 different groups, which make it easier to show that actually, if we can figure out how they're doing on those things, so on the environmental side, for example, how they're doing on the impacts that their materials and goods and energy and water have to do on the environment is a pretty good proxy for how they're doing on those 3 environmental goals, and how they're doing on greenhouse gases, et cetera, is a pretty good proxy for how they're doing on these goals. So if we can figure out how we're doing on these issues, and we can map them to the related SDGs, we can figure out how we're doing or contributing to the SDGs. And that's the language that's usually used with the SDGs. Companies report on how they are contributing to the SDGs, helping to meet those. Because a lot of the metrics and targets associated with the SDGs, there are 17 Sustainable Development Goals. There are 169 targets associated with those. There are 230 indicators, which is really quite a robust set of things. Unfortunately, though, many of those targets and indicators are more intended for governments to keep track of how all of this is going than businesses to measure their contribution. And that's why if we can have these contributions assessed by the factors that we looked at before, we can map the scores on those to the related SDGs and see how we score on the SDGs. And there is a tool that helps you do that. Down at the bottom, there's a free open source SDG assessment toolkit that you can download from my website that helps you do all of that. Let me emphasize that it's free and it's open source, so you can do whatever the heck you want with it. But it's a tool to help you perhaps report in a more complete way and robust way on how you are contributing to the SDGs. And if you only want to report on a couple, it'll help you do that. Just choose those. So the Sustainable Development Goals are starting to gain some traction in the business community, starting primarily in Europe, but now in North America. More and more companies are saying, yeah, I care about these things too. They already did probably, but there's sort of a halo effect around the SDGs to say, yeah, we care and we're contributing to those things, and here's how we're doing that. Usually though, companies don't report on how they're contributing to all of the SDGs. They usually are a little selective about which ones they talk about. which they deem to be the most material ones for them. So in terms of the way in which different geographies choose ones that they prioritize or report on, as you can see, it depends on where the company is. Asia Pacific and Europe and North America have a slightly different set of 5 that are the most popular ones, but you can see that there is some commonality. Just about all of them choose the good health and well-being. That gets into human rights. They talk about climate action as well. They talk about this responsible consumption and production, which gets into the circular economy and materials use and so on, renewable materials. And then there's some variation in the middle too, but frankly, they change every year. It's basically the group that you see here that are the ones that are most frequently reported on. The ones that are almost never reported on are ones like the health of the marine systems and so on. For some reason, companies don't report on that or choose to, but it's voluntary. So, you know, they can choose whichever ones they want. So I've talked about the Global Reporting Initiative and the SDGs as frameworks that cover all the bases that you would normally think needed to be covered in terms of sustainability. And then there's something called an integrated report, which is starting to get a little bit more traction as well. As you can see from the report before, some companies are saying that their report is an integrated report. And this is the way in which that compares to the others. This is, this is usually called the octopus chart. What the report talks about is the capitals that the company takes in at the beginning of the year into the company. It does something with it. So this is their version of the business model. And it does something, produces outputs and outcomes. And at the end of the year, it would be interesting to know whether they have added or subtracted value from these capitals. So the 6 capitals are financial, manufactured, and intellectual capital, which are fairly easy to monetize. So that's fairly straightforward. Intellectual capital perhaps being the value of patents and copyrights and those kinds of things. But the 3 at the bottom, the human capital, the social and relationship capital, and the natural capital, those are a bit of a challenge to be able to quantify, to describe with some numerical kinds of scores. And when you're trying to see whether or not you added or subtracted value from human, social, and natural capital from what they were at the beginning of the year and what they were at the end of the year, it kind of helps to be able to assess the before and after state of those capitals and whether they created value over the period of the year. So the intent of an integrated report is to enable companies to do that in a structured way. So when we're talking about these capitals, it's just different labels for the nests that we talked about before. Natural capital being the environment, human and social capital being society, and human capital being when it's working for the company. And then we have financial and manufactured capital. So just to get through the maze of terminology here, we're talking about the same stuff, we're just using different labels for it. The integrated reporting folks, the International Integrated Reporting Council, has put out some excellent guidelines on how you would know an integrated report if you ever found one. And it has 8 elements that it says it should include. And basically, this could be used as a table of contents for an integrated report. What's the purpose of the organization and who are its stakeholders, not only shareholders, but stakeholders? The governance structure and the competence of that governance structure on all things, the business model of the company, the risks and opportunities that are on the horizon for the organization, strategies and resources, and its performance. And this, of course, is the big section. And the interesting thing about an integrated report is it integrates financial, annual report type stuff, and non-financial in the same report. So that's why it's called an integrated report. Both kinds of reports are embodied in this report, hopefully in an integrated way. And then there's an outlook, which is sort of a management discussion and analysis of how things look in the future, and a little bit about the basis of preparation. So those are the elements that are normally in there. And just to map those against the things that we were looking at before as being the normal issues that would be covered in a sustainability report, it covers all of those things, and it also covers the financial aspect that you would normally see in an annual report. The financial capital is basically the income statement and balance sheet and so on, and a lot of the governance factors are covered off too. As you can see, there's a whole section of the report that would normally cover that as well. So this is a very, very comprehensive, integrated framework for reporting on everything. For whatever reason, it's not as popular in North America as it is in Europe yet, but I just want you to be comfortable with the fact that it's really kind of an augmented annual report that not only covers all of these things, but it covers these, and hopefully it also connects the dots that says if we're doing good things on the environment and society, it's positively impacting our finances. In other words, these are less isolated from each other. You can see cause and effect kinds of relationships, that we're doing this, this, and this for society. It's improving our reputation. That reputation is driving more revenue, etc. So it helps them see that actually doing more and better on some of these sustainability or ESG related things also can help you be a better company, a more successful company. And that's a good story to tell. And this framework allows you to tell that story better than any of the other frameworks. Okay, so far, so I've covered the three most popular ones: GRI, SDGs, and integrated reports. I'm going to cover a couple of others, but welcome for any questions if you want them.
There is a question that's come up. So in your experience, how do companies effectively initiate and manage such a comprehensive undertaking?
For any of the frameworks, you mean, or any in particular?
I think it's just kind of a general question. Like, how do you kind of, I guess, start this whole thing off? Yeah, and the asker just said any.
It really comes into who's asking. If the company voluntarily would like to tell the world how responsible it is, what a good corporate citizen it is, that was the origin of a lot of the early CSR, corporate social responsibility, or citizenship, or sustainability reports. There are new voices in the chorus that are asking for things these days, though, and that brings me to interest of the stakeholders, the investors, in some of these sustainability issues that is a lot higher than it used to be. So they're curious about this stuff now, as well as the financial success and health of the organization. They'd like to know how the company is doing on these things and whether it is getting ready for some of those boomerangs. Is it ready for climate change? And if it's not ready, it could be a risky investment. So let me just lead to that in terms of what companies may be encouraged to report on. So SASB, the Sustainability Accounting Standards Board, is an organization that is looking at all of these issues and saying, actually, does a company need to report on all of these things if it is trying to reassure its investment community that it's doing the right things, that it's behaving properly and performing properly? Or are some of these more material, more relevant, more of interest to investors? If you are a bank, for example, would investors care about how you're doing on water or how you're doing on encroachment? Or would they be more interested in greenhouse gases if you were a manufacturing company emitting a lot of greenhouse gases, or in a sector which does that, emits a lot of greenhouse gases? So they say, well, actually, you don't need to report on all of them in order to reassure investors that you're doing the right things. So what they've done is they've taken all of these and they've produced a matrix, a map that says, here are all of the factors down the left-hand side, and here are all of the sectors across the top, and these are the things that you should be reporting on. And this is a bit of an eye test, but this is a screen capture of what they call their materiality map. So what they do across the top is they list the sectors. And in fact, they look at 11 sectors, and you can explode each of those into their sub-industries. So this is an interactive page on the website. So if you clicked on any of those headings, it would explode into the sub-industries within that and show you which of these ESG issues, ESG issues over on the left-hand side are material for your particular company. So just, I know that's an eye test, but it has a group of environmental things, social capital, human capital, business model, and also leadership and governance. So it covers the same bases that you would normally expect it to. But what it's showing is that actually some of these are going to be of more interest to investors than otherwise. And that's why SASB started off as being something that they were trying to get the Securities Exchange Commission in the US to require any organization or company that wanted to be listed on a stock exchange in the US to include this kind of information in it's called a Form 10K, which is the way in which a company describes itself to potential investors if it's going to be listed on the stock exchange. So this is the kind of information that they thought would be useful. So it's selective, and materiality is really material to investors, that it could help them be reassured that you're paying attention to the right things and avoiding potential risks associated with not paying attention to the right things. So it's a more selective one. So how does that map to all of the factors we looked at before? This is the map that shows you how that works. So that's guidance for companies, and some companies follow that guidance when they are choosing which of the GRI or SDG or other things they want to report on. They're using SASB guidance to subset them, so they don't cover all of those factors, but just some of them. Then there's something called CDP, which is also a subset. This doesn't look at everything. CDP used to be called the Carbon Disclosure Project, but because now it's looking at more than carbon, they just use the acronym CDP. And what they do is they look at how companies are doing on their climate change initiatives, both mitigation and adaptation, their water security, and how they're impacting forests. Forests have a lot to do with climate change because they're such a huge sink for carbon dioxide. So they're closely related, and so water is the second biggest issue facing us on the planet other than climate change. So it's a big, they're trying to zero in on the things that are most important. And they also are zeroing in on things that are most important to investors, because if you're not ready for climate change, or if you're a bad actor on climate change, then you may not be a company that investors want to put their money into. So they send out a questionnaire to large companies, and you can see over the period of time from 2003 to 2018, the majority of the responses they get are relative to climate change. And there are some companies on the little blue ones here that are reporting on water, and there are some that are reporting on forests, which are the dark green ones. But the majority of the reports are on climate change. So it's a subset of all of the things. It's not the whole ball of wax. And specifically, it's about energy, water, greenhouse gas emissions, and encroachment or biodiversity and impact on forests. So those are the things that CDP talks about. Not all of the other stuff, not the society, not the employees. They talk about governance as well to make sure that you are setting up your policies and procedures and systems and so on to do the appropriate things on energy, water, greenhouse gases, and forests and so on. But it's a very tight subset, very focused subset. Again, from an investor perspective, that may be important information. That's why they're gathering it. And then there's one other one that is a more recent arrival on the reporting scene, and that's called the TCFD. So I'm going to drill down on that next. Any questions so far?
Yeah, sorry, Bob, I had trouble getting my mute off for a second there. So has anyone studied the financial return to pursue one of the following, GRIs, SDGs, and IR?
You mean the financial return to the organization?
I believe so, yeah.
Yeah, it doesn't make any difference. It doesn't make any difference. But if you want to think of the ones that are of most interest to investors as sort of a proxy for which ones have the highest potential to impact your financial returns, it would probably be carbon, either as defined by SASB or by CDP. And I'm about to explain a little bit more about that. But there are frameworks, and in fact, I've got some free open source frameworks on my website that help companies assess whether or not doing more on some of these issues is good news or bad news from a financial perspective. So to do a cost-benefit analysis of the wisdom of doing that. So there are tools that allow you to do that. So the project-related business case tools on my website help you do that. Okay, so let me give you a little insight into this thing called TCFD. If that's a new acronym to you, it's one that you may start hearing a little bit more about if you haven't heard about it already. So it's very focused on climate. So it has to do with greenhouse gases and the extent to which you are converting your operations to use renewable energy versus fossil fuel energy. So what is this thing? Well, it's a task force. It was a task force that was commissioned by the gentleman on the right. Mark Carney used to be in charge of the Bank of Canada, more recently the governor of the Bank of England, and currently he is, as of January of this year, the UN Special Envoy for Climate Action and Finance. He's very, very concerned about the impact of climate on the financial health of all economies. And he commissioned this gentleman on the left, who you may recognize, Goldberg, Michael Goldberg, as the guy to lead this task force on climate-related financial disclosures. And they recommend voluntary climate-related financial disclosures that are consistent, comparable, reliable, clear, and efficient, and provide decision-useful information to lenders, insurers, and investors so that they can evaluate their risks and their exposures over the short, medium, and long term. So just to be clear, this is so that they can evaluate their risks and exposures. These folks are not trying to save the world. They're trying to save their assets to make sure that they're in good shape. So you don't want to put your money into a company that's going to get whacked by climate change, that's not ready for climate change. It hasn't thought through the way it could be impacted or indirectly impacted through their supply chain and their customer locations by climate change. So they just want to know, have you thought this through? Have you figured this out? Have you adjusted your business model accordingly and your supply chains accordingly? And they want to understand how these disclosures include how climate-related physical liability and transaction risks are assessed, priced, and managed. And transition risks is just code for the fact that we have to transition from a fossil fuel-based economy to a renewable energy-based economy, which is a huge transition. And are you ready for that? Have you figured out how much that's going to cost you? That's what they want to know. So what they're doing is they're asking you to provide information that maybe before you didn't. But if these guys ask for it, it's a little bit more important to respond to this request than if some tree hugger asked you for this information. So these guys control capital, and in a capitalist system, that they're kind of important people. So if they think it's important to know, then it's important to know. And in fact, these recommendations have been adopted by an incredible number of people who provide that capital. There are companies or organizations in the public sector that are cozying up to these as being appropriate things that companies should disclose. And in the private sector, firms that invest in organizations, the insurers, companies in the high impact sectors are especially interested in them because they want to be able to continue to be supported by the investors. So these are getting a lot of traction. And specifically, they're asking for disclosures around 4 things. They'd like to know how the governance system of the organization is set up to ensure that it includes and accounts for climate-related risks and opportunities. It wants to know whether the strategies, short, long, and medium-term strategies, are making sure that they're ready for these risks and can capture the opportunities. They want to make sure that the risk management system in particular is legitimizing these climate-related risks as important enough for them to think through. Do they have a scenario for what the risk is if the temperature goes up by 1.5 degrees centigrade above pre-industrial areas, pre-industrial levels, or 2 degrees, or 3 degrees? Are you ready for that? What does that mean to you? How do you prepare yourself for it? They just want to know. And are you using appropriate metrics and targets to be able to do all of that? So it's basically they're saying, have you done a cost benefit analysis of you doing more than you've already done on this, or have you done a cost benefit analysis of not doing anything? Just like to know. And in fact, what they would like to see is the way in which you have looked at all of these risks, transition risks and physical risks, and all these opportunities, and the way you've done an assessment on the way in which doing the right things or what you're doing now is going to impact your income statement or your balance sheet. Just curious, have you done that analysis? Could we see it, please? So companies are starting to need to frame that, and there is a way, in fact, there is a way to do that that I make available on my website called the Climate Change Adaptation ROI Workbook that takes all of those factors, maps it into the way in which a company would normally look at any major project. So it's called the Climate Change Adaptation ROI Workbook, and it shows the way in which you've allowed for those opportunities to save some money and make more money, the way in which you've allowed for the balance sheet, the assets, to be impacted positively or negatively by what you're doing on climate change, the way in which you've assessed the risks, that's a huge section, and the way in which you've figured out whether or not this is worth your while to pay more attention to than you've already paid attention, than you already have. So it's, treat getting ready for climate change as a project and size it. What's the cost benefits of doing that? So there are tools available to help you do that. The main point, though, is that this thing, the climate crisis, climate emergency, climate change, whatever you want to call it, is becoming more and more of interest to investors, and bankers, and insurers. And if they think it's important, it's important. And therefore, the way in which you disclose, report on how you're doing on those things is very, very important to them. So let me stop there. I'm not going to drill down into the others. And by the way, just a reminder, on this particular slide, there's a footnote that says that there is a comparison of these frameworks that's available on my website as well. So I'd take a look at all of these frameworks and how they address each of those issues that we talked about before, and how they ask about them, and how they suggest that you calculate your performance on them. So it's a fairly humongous spreadsheet, but it shows all of the reporting and rating frameworks across the top and all the issues down the side, and shows how they compare. It might be useful as you're trying to decide which one is most appropriate for you to use. Okay, questions?
Yeah, we've got a couple.
Great.
Thanks, Bob. This has been a great presentation. So first question I've got is this. I believe you said the goal was to have all SEC companies use the SASB. Are any sustainability reports required for the NASDAQ or the New York Stock Exchange?
Okay, so the intent, let's go back to that. The intent when SASB was first started up was to get the Securities Exchange Commission to require the NASDAQ and the Dow and all of the New York Stock Exchange and so on, to require American companies listed on American stock exchanges to disclose the kind of information that they think it is appropriate for them to disclose as identified in this map. It hasn't worked. So those stock exchanges, they may say, we'd like to know how you're doing on carbon, but the degree of rigor by which they would like companies to report on that is a little bit lame. And we have yet to see any company delisted from the stock exchange because it has not reported appropriately. So it's an aspiration that they would get stock exchanges in the US to do that. Since it started up, they're realizing that, of course, these are appropriate for any stock exchange. So it's become a lot more global in terms of trying to get any stock exchange on the planet to require companies to disclose these kinds of things in order to be listed on the stock exchange. Some exchanges are ahead of others, like South Africa and so on, but there are none of them that, as far as I know, have adopted these recommendations completely, including the Toronto Stock Exchange.
Okay. All right. Thanks for that. So here's a good question. So which reporting guideline do you view as the most transparent from an environmental standpoint?
I've got a biased answer here. The FutureFit business benchmark is the most transparent. I mean, it really says how close are you to where you need to be on all of the things you should be paying attention to from an environmental, social, and employee perspective. So it's comprehensive and it's very science-based, best available science, social science as well as environmental science. Plus, it gives you a chance to tell your good story about the positive pursuits. So I'd say that's probably the one that you could trust the more because the rigor of those calculations is pretty strong.
Okay.
But it comes back to the question you asked before too, which is who's looked at this, who's audited this, who's confirmed, who's validated these things that you're saying. So the assurance of these reports is almost as important as the information that's in them in terms of its credibility.
Okay.
And by the way, the consulting firms, the big consulting firms, there's usually a practice within those consulting firms that make their money by doing exactly what you're suggesting. They audit these things and give the company their good housekeeping seal of approval on the fact that these things represent reality in the organization and the methodologies that they're using are appropriate for the calculation. Some of the big four consulting companies are the same ones that the company was using anyway for its financial stuff. And many of them have practices that are specializing in sustainability, so they just use the same firm. But it's a little tricky if they use the firm to not only audit their report, but also help them get better results for the next year. So they need to usually kind of have a little separation there.
Okay. So I have two more questions. I know we're kind of coming down to 2 minutes. So this one's pretty straightforward. I'm going to save maybe the challenging one till last. Who are the leaders in the audit of these reports?
I don't know. I think some of the non-governmental organizations, NGOs, are really good at it, but I don't know. Okay. But it's an excellent question as to who would you go to for reassurance. If you got Greenpeace to bless your report, that would be huge because they are not known for being easy on organizations. The Pembina Institute out of Calgary might be good because they are also very credible. WWF maybe, I don't know if they're into this that much. Maybe the Suzuki Foundation, but again, I don't know if they do that kind of work. But organizations which have a public reputation for being a little hard-nosed and aggressive on these things, so that you can be assured that they have really taken a close look at what it is that's in the report.
Okay. So this the next question kind of pertains, I guess, a little bit to the current situation we're kind of in globally. So I recognize that this might be a bit of a difficult question to answer, but at the same time, I note that it's also a question that I know I've had and kind of discussed with some friends and coworkers as well. And that's the question is this. So how do you think a company's response to COVID-19 relates to this sort of reporting? Do you think investors or those who read the reports will be looking in specific detail at a company's response to this situation? I guess it kind of comes down to, do you think these two, major responses to kind of a global situations, obviously one is, a lot more immediate in some people's minds. Do you think they're kind of at odds with each other at all?
So the place that they could tell their story the best is how they are treating their employees during this god-awful situation and how they are trying to help their community contend with it. So a lot of the employee-related stuff that we talked about before has to do with how you treat them, not only when things are going well, but when things aren't going well, when they're sick. So the employee health and well-being aspect, the extent to which they are covered by paid sick days, the additional help that you can provide to them in tough situations, the extent to which you have set up your workforce so that they can still be productive even if they're working from home. There's lots of good stories you can tell about that aspect of it as well. Then there's the society part, the community relations part, and the community positive contributions. And there are some large companies that are doing amazing things to try to help the way in which the health professionals are trying to deal with this in society, and supporting all of the government guidance on what could and should be done, paying a price for it in many cases. But I think there are many good stories to be told there. More on this on the employee side and the community side than on the environmental side.
Okay. Well, we're just kind of a little bit over time now, but I want to kind of echo some of the comments that I've gotten as well in the question box. So very great presentation. I think it was very, very informative. I think we kind of got a good outline. I think everybody got a pretty good outline of, the various options that are available to them. I think it's something that is pretty new to a lot of people, so it's very much appreciated. So yeah, thanks to yourself, obviously, Bob. It was a great presentation. And just to kind of echo what we kind of said at the beginning, we will have both a recording of this webinar and the slides available to participants afterwards. So kind of keep an eye on your email. Within the next coming days, we'll be sending those things out. But yeah, once again, thanks very much for your time today, Bob, and thanks for a very, very informative presentation.
It was a pleasure, and thank you for helping with the logistics of all of this, as well as helping people get their heads around this in a way that hopefully is going to be useful to them. The number one question you should ask yourself when you're trying to decide which of these frameworks to use is, who is the report intended for? Who is your audience? And work backwards from that as to what that audience needs to know, wants to know about how you're doing on these things. And that's a pretty good way to zero in on the most appropriate framework for your purposes, that it's fit for purpose. And go for it. Use any of the tools that you saw listed across the bottom of the screen if they're helpful to you. Many of you are probably already doing a lot of this stuff anyway. But if you're new to it, some of those tools may be helpful.
Great. Thanks very much again, Bob. And of course, if you do have any further questions that maybe weren't answered in the webinar or that you couldn't get a chance to kind of get out, feel free to contact myself or Tom Brown that kind of send out all the invites, and we'll be happy to reach out to Bob and hopefully get some answers for you. So thanks once again very much, Bob. I appreciate it, and I appreciate everyone's time today.
Thanks for the opportunity. Take care.
Okay, everybody, stay well, take care, and we'll be talking to you soon.